Bill Ackman is a pro at decoding economic signals. He's shaking things up by foreseeing potential rate cuts from the Federal Reserve, and it's happening sooner than you might think. He breaks down key factors like real interest rates and inflation, challenging the market's expectations and highlighting the risk of a hard landing if the Fed doesn't act fast. So join us as we explore Ackman's insights into why he predicts early rate cuts. Ackman's predictions go beyond surface-level market movements as he reveals 3 real estate investment trusts that could stand out in this changing landscape. In the complex world of market predictions, Bill Ackman stands out as a master. He not only interprets signs vaguely, but decodes a whole set of economic signals that could reshape the entire playing field. The Federal Reserve was once known for signaling rate hikes, but is now showing potential signs of changing its stance. With his keen financial foresight, Ackman predicts upcoming rate cuts, envisioning a shift as early as the first quarter of 2024. Looking into Ackman's insights reveals a detailed view of the economic landscape. He explains why he expects rate cuts sooner than what the market anticipates. The real interest rate, a crucial factor affecting the economy, is increasing as inflation goes down. Ackman argues that keeping rates in the mid-5s with inflation below 3% results in a high real interest rate, which could hinder economic growth.
I think they're going to cut rates, and I think they're going to cut rates sooner than people expect, because what's happening is the real rate of interest, ultimately, which is what impacts the economy, keeps increasing as inflation declines, right? So if the Fed keeps rates in the sort of middle 5s, and inflation is trending below 3%, or that's a very high real rate of interest.
There's a looming risk of a hard landing if the Fed doesn't act quickly. Ackman challenges the market's expectations, suggesting rate cuts could happen as early as Q1, contrary to the consensus of a mid-year adjustment. What does this significant shift mean for investors? The market has reacted quickly since the Fed hinted at maintaining rates. Stocks have soared, reminiscent of the rapid market movements seen in the 1970s. The S&P 500, in a financial roller coaster, has made its fastest comeback from correction territory in just 16 trading sessions. However, Ackman's predictions go beyond the surface, painting a clear picture of a potential cliff-like effect as individuals and businesses rush to reprice their debt. This exciting episode isn't just guessing, it's a detailed look at potential outcomes. Ackman goes beyond the rate cuts, focusing on the risk of a hard landing if the Fed doesn't act quickly. It's an exploration of what's beneath the surface, examining how these rate cuts could shake up the real estate market. In Ackman's words, predicting is really hard to do. I do think the economy is weakening.
I think it's really hard to predict. I do think the economy is weakening. We're seeing evidence of that in some of our companies. You're seeing, and I have some concerns. There's been a huge subsidy in terms of low interest rates, and most companies fix their rates or their debt at very low rates, and certainly real estate investors did the same.
His worries come from signs in some companies hinting at a broader economic downturn. The support of low interest rates, a big driver of economic activity, raises questions about how long it can last. Companies and real estate investors have benefited from low rates, but Ackman points out that this dynamic works until it doesn't. The potential issue when the debt needs to be repriced becomes a focus, with implications for the real estate sector. Making this financial story more complicated is considering currency dynamics. As rate expectations change, be ready for possible weaknesses in the US dollar. Ackman navigates the dance between economic data, currency movements, and market sentiment. It's not just a prediction, it's deciphering the connected forces shaping the financial landscape. But the excitement doesn't end there. Ackman sees rate cuts as a turning point, and we're looking at 3 real estate investment trusts that could stand out in this changing landscape. These carefully chosen REITs might be the key for investors navigating a big shift in the financial markets. So, the first on our list is Realty Income Corporation, known by its ticker symbol O. Beyond just dividend opportunity, Realty Income offers a financial adventure set to unfold in a compelling story. With talks of potential Federal Reserve rate cuts in the air, Realty Income stands out, ready to rise above the challenges of 2023 and embrace a new era of growth and opportunity. Traditionally attracting income seekers, Realty Income tempts investors with a monthly dividend boasting an exciting 5.81%, yet its appeal goes beyond instant income. It presents a strategic move for total return, deftly navigating the complexities of interest rate challenges and market volatility. The hurdles faced by Realty Income in 2022 and 2023, reflecting the broader real estate market, become the canvas where savvy investors paint opportunities. Echoing the wisdom of Warren Buffett, the recent acquisition of Spirit Realty Capital for a significant $9.3 billion stands as a bold move in Realty Income's commitment to diversification. This strategic step aims to lessen the impact of its top 10 clients on its total portfolio, showcasing a forward-thinking approach in the face of dynamic market conditions. Realty Income's expansion into Europe in 2019, contributing around 14% of its annualized contractual rent, further emphasizes its dedication to global growth and resilience. Being a real estate investment trust, Realty Income has a duty to distribute at least 90% of its net earnings to shareholders as dividends. This unique tax advantage not only supports consistent high dividends, but also sets the stage for potential capital appreciation. With an impressive track record of increasing dividends for over 25 consecutive years, Realty Income proudly holds the title of a dividend aristocrat. Now let's look at the interesting dynamics of Realty Income's valuation. The REIT currently trades at a valuation that can be considered low, making it an attractive option for investors seeking total return. The historical price-to-funds from operations ratio, around 18.52%, translates to 13.5 times. With the anticipation of possible interest rate cuts, the market foresees Realty Income trading at a normalized P/FFO of 17 times by 2027. If this prediction comes true, the estimated stock price could be around $79, representing an annual capital appreciation of 7.3%. When combined with the current dividend yield of approximately 5.5%, this suggests a potential overall annualized rate of return ranging from 12.1% to 13.3%. Next on our list is EPR Properties, identified by its ticker symbol EPR. This unsung hero is gearing up for a financial adventure. As talks about potential Federal Reserve rate cuts gain momentum, EPR stands resilient, ready for an exciting ride to the top. EPR's financial performance in Q3 2023 reflects a skillful orchestration focusing on strategic moves and optimizing assets. A standout moment is the restructuring agreement with Regal, a bold move securing a significant part of EPR's investment portfolio. This strategic step not only shields against past volatility, but also lays the groundwork for a stable and predictable future. The highlight of the restructuring is the transition of 41 properties into a new master lease, a clever move that minimizes risks from Regal's past bankruptcy and ensures a reliable revenue stream for EPR. This success is evident in the stock price, which has seen a noticeable rise after Q3 2023 earnings, driven by positive signals from technical indicators. EPR Properties is not just surviving, it's thriving, and the momentum seems unyielding. Looking at Q3 2023 earnings, EPR emerges as a company navigating smoothly towards financial prosperity. The Regal restructuring stabilizes a substantial part of EPR's portfolio, reducing financial uncertainties. Selling non-core properties strategically optimizes the asset base, showcasing financial health and wise decision-making. The numbers speak for themselves. Quarterly revenue has surged $189.384 million to $614.1 million in Q3 2022. Net income tells a similar story, climbing to $50.228 million from $44.769 million. With only $136.6 million maturing in 2024, a fixed interest rate shields EPR from the volatility of rising interest rates. The CEO steps into the spotlight to highlight strategic wins, strong earnings, a steady portfolio, a successful box office, and careful capital deployment. These success notes echo EPR's financial story. While the payout ratio may have risen, it reflects the company's dedication to investors. In the exciting financial tale of EPR Properties, investors encounter an anthem of opportunity. Charts, financial health, and smart strategy come together, promising not just stability, but an exciting journey to financial success. As investors explore EPR Properties, they encounter a compelling story beyond just numbers. The restructuring deal with Regal, a crucial move, prompts a closer look at the broader real estate industry. It emphasizes the importance of strategic partnerships and adaptability in an environment that demands quick and resilient actions. The sale of non-core properties, another strategic move by EPR, sparks questions about the company's vision and approach to optimizing its portfolio. Investors may dive into the details of these transactions, evaluating how they align with EPR's long-term goals and the overall direction of the real estate market. Understanding the reasoning behind these decisions adds depth to the story, letting investors assess the company's strategic insight. Moreover, the CEO's focus on careful capital spending raises questions about the company's investment approach. As EPR Properties gears up for a dynamic financial journey, investors may want to understand how the company assesses and chooses investment opportunities. The interaction between market trends, economic indicators, and EPR's decision-making process becomes a key point of interest for those trying to understand the details of this financial landscape. Next on our list is Innovative Industrial Properties REIT, identified by its ticker symbol IIP. It stands out as a unique and innovative player, breaking away from the usual path of real estate investment trusts. Unlike its counterparts, which often focus on reliable income strategies, IIP positions itself as a growth stock, ready to navigate the dynamic and high-growth landscape of the cannabis industry. Amid the whispers of anticipated Federal Reserve rate cuts circulating in the financial sphere, IIP strategically places itself ready to take advantage of a unique niche in the vast realm of real estate. The upcoming journey promises not just excitement, but a practical exploration of IIP's ability to demonstrate its expertise in an industry that is not only unconventional, but also rapidly changing. A closer look at IIP's operations reveals a strategic and forward-thinking approach in the cannabis cultivator space. The REIT sets itself apart through a mix of net lease programs and sale-leaseback positions, strategically directing investments towards cannabis cultivators and operators. Breaking away from the usual REIT strategies, IIP becomes a strong player in the growing cannabis industry, driving returns in a different way. What sets IIP apart is its smart risk management. About 90% of the base rent comes from multi-state operators, a move to lessen risks linked to changing state laws. Recent improvements in rent collection show IIP's resilience, handling challenges like failed collections from key players without losing overall momentum. Boosting stability is the impressive average lease term of 14.9 years. This long-term commitment not only assures investors, but also shows IIP's dedication to building a solid foundation in a volatile industry. It's a strategic move that looks beyond short-term gains, making IIP a strong player in the ever-changing cannabis scene. In the latest financial update, IIP's third-quarter earnings took the spotlight, beating expectations with a revenue increase of $1.26 million. Looking closer, IIP's financial finesse, especially in tenant reimbursements, played a key role in offsetting non-core factors affecting earnings, like litigation charges. This shows IIP's skill in handling complex financial situations and positions it as resilient against unexpected challenges. The positive outlook on IIP RE remains strong, based on the steady growth in the cannabis cultivator space. IIP's strategic moves and robust operational strategy set the stage for an exciting future. However, investors should be mindful of legal challenges in the cannabis industry, potential economic downturns, and the risk tied to IIP's focus on the cannabis niche. As the story of IIP unfolds, investors enter a fascinating journey into the high-growth world of cannabis real estate. Despite the optimism, it's crucial for investors to take a nuanced view. The cannabis industry, while full of potential, comes with legal complexities and uncertainties. The ongoing federal stance on cannabis legalization in the United States plays a significant role in shaping the industry's path. Investors need to closely watch legislative changes and the potential for regulatory shifts affecting IIP's operations. Additionally, the economic landscape adds another layer of consideration. With talks of anticipated Federal Reserve rate cuts in the financial discussions, investors must assess broader economic impacts. While lower interest rates can boost economic activity, they also bring risks like inflation and asset bubbles. Navigating the complex terrain of IIP requires a vigilant approach from investors considering the intricate dance between monetary policy and economic indicators. In the real estate scene where a property is located often plays a crucial role. This holds true for IIP's investments in cannabis real estate. The REIT strategically places itself in states with legalized cannabis markets, aligning with the ongoing trend of expanding legalization across the United States. However, investors should be aware that the legal landscape around cannabis is subject to change. The potential for shifts in laws or regulations emphasizes the need for a thorough understanding of the legal details that could affect IIP's investments. The intricacies of IIP's operations go beyond financial numbers and legal matters. Environmental, social, and governance factors are gaining more attention in investment decisions. As the cannabis industry deals with sustainability challenges and social implications, investors may closely examine how IIP handles ESG factors. Evaluating how the REIT addresses environmental considerations, interacts with local communities, and upholds ethical standards becomes crucial for a comprehensive assessment of its long-term sustainability. Thanks for tuning in. Hit subscribe for more insights and let us know your thoughts on Ackman's predictions in the comments. Catch you in the next one.